Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is a new guest on the show, Lynette Zang. She's the Chief Market Analyst at ITM Trading. How are you today, Lynette?
I am excellent and very happy to be here, Tom.
Well, it's quite a pivotal day to be able to speak with you. I was excited to be able to get to be one of the first people to get your thoughts on Powell's speech from Jackson Hole. So could you give us kind of an overview on any new developments that we saw out of his speech today?
Well, actually, the last time that a Fed chair made such an important speech was in the monetary regime shift that happened in the 70s. And they like to do this really quietly. You know, the population thinks they're going to see just this big, huge bang, but that's not really the way central bankers work their policy. So today was really quite a significant shift from inflation targeting from 2%, that's what they're looking for, to allowing inflation to run hotter. Now, the interesting thing about it is that they have not been able to hit their quote-unquote 2% inflation target, though for you and me on the ground, I'm pretty sure that food prices have gone up way more than their 2%, as has education and insurance and all the things that they don't count in inflation. That's not enough for them. I really think that this is about them knowing that the game is over, that inflation is going to be, they're preparing to lose control of it, but to be able to appear as if they're remaining in control, because now they're going to target an average 2%. They supposedly haven't been able to hit their 2%, but now they're expecting it to run hotter, and so therefore they're going to do an average. I hope all your listeners are ready for this.
Yeah, so they seem to be preparing for something that they know is going to happen and in a way save face by heading it off at the pass and acknowledging it before we get there, correct?
That's exactly right, Tom.
So, Lynette, you seem to be an expert on all things Fed and government related. And in 2015, the IMF working paper, Breaking Below the Zero Bound, you were saying that number 8 is being pushed through right now, like on their list. So could you tell us what that list consists of, what number 8 is, and how that's being pushed through the Senate and Congress at the same time?
Well, you know, that is one of my very favorite papers, and it's very easy for anybody to find, and I also think that it's a very easy read. And first, let's explain what they're talking about there, and that is how to get rid of cash so that they can push interest rates significantly below zero. Because right now, with dollars, you know, you have a 1.00. What most people don't realize is that a dollar is actually a debt instrument. So what we're really seeing in here is a level of constraints for the central banks in pushing interest rates below that when you have most of the world anchored at zero already. You know, and does that even make sense to anybody? No. What that means is if the central bank wants you to spend your money, then they need to have you see your principal evaporate to inspire you to go out and spend. Does that make sense? I mean, it doesn't actually really make a whole lot of sense if you want to know the truth. But that is what they're talking about. They came out with another paper in 2017, how to go significantly below zero. But what is happening, as you talked about, in that beautiful paper, they have an 18-step process on how they will transition us to cashless and get us to volunteer without them having to do anything, getting you to volunteer. In the paper, they say that they can have this implemented within weeks by simply going to the central bank window when, like your commercial banks like Chase and Wells Fargo and Bank of America and all of those guys, right now, whenever they want to withdraw money, they go to the central bank window. So they can do that directly. In this, they have a beautiful outline. It is an 18-step outline on how to make this transition and make it invisibly. Number 8 actually says, formally make money in central bank certified bank accounts, legal tender. And so what has happened actually on August 6th is the Fed Now account has been formally announced, and they're beginning to implement it through every commercial bank. So again, Chase, Wells Fargo, Bank of America, etc., as well as every non-member state bank, credit unions, and the post office. There is a bill that is currently going through the House. It's the Banking for All Act, and this enables central bank money to replace traditional accounts where you and I might make that deposit, but the central banks will actually be able to make direct deposits to the individuals and be in absolute control of their policy. Right now, when they make a policy, it takes like 18 months to go through the whole system, driven by the banks creating money, but it takes 18 months till they know if their policy worked or not. With these new accounts, where the money in these accounts are central bank legal tender, then they have absolute control over the value of the money in those accounts. So with dollars, the current system, they can't go really past 0.00. They have 2 digits that they can go. With the electronic money, it's unlimited. So the way they've used inflation to remove the purchasing power value from the money while maintaining the numbers, the nominal amounts on that money, now they will be able to rob you of your principal either quickly so you see it and decide to go spend money, or slowly where you don't see it but it's still gone. Kind of like their inflation target of 2%, that's low enough so that the public doesn't notice and start screaming about it, but it's high enough because everything is costing you at least 2% more every year. And if your wages, your income, does not keep pace with inflation, which is the way it's set up by design for the average wage earner, it's designed never to keep up with inflation. Well then, as we've seen, particularly since the 70s when we went onto the system, is that households were taking on more debt in order to maintain the standard of living that their income could not support, but yet that they were used to.
So there's a couple of advantages for them to create this digital dollar, correct?
Oh, yeah.
In a way, they could almost put an expiry on the digital dollars that they could lend directly to the consumers, and or by creating negative interest rates, forcing people, like you say, to go out and spend the money on something that seems tangible and to hold better value than the dollars that they're holding in that account, right?
Yes. And again, when they make a policy move, they do like distance between themselves and the public so that the public doesn't realize that it's actually coming from them. And I'm sure a lot of your listeners, if you tell somebody, well, why don't you go and take out $11,000 from your bank account? And their response now would be something like, well, I don't want to do that. They're going to report it. Well, that is called perception management, and chances are pretty good the bank doesn't have the cash to do that anyway. But once the central bank is in full control of that, then that's their ability to take those rates deeply negative or not, but inspire you to do what they want you to do without you even realizing it. For governments, the advantage is their ability to tax you, because if everything is run through a digital system, including if the title to your wealth is held there, all of your earnings, everything that you spend, well, what the government is talking about is their ability to do a lifetime tax. And if it's all digital, they can actually determine when that tax gets paid. And you wouldn't have any control over that. And that really is what it's all about, whether it's for the governments or it's for the central banks. It's all about taking more and more and more control and leaving the public with less control.
Absolutely. So as we're seeing, this is being pushed through the Senate and Congress right now, correct?
Oh, absolutely.
And it should be law slated kind of for January 1st, 2020 run, right?
Yes, that is what's in their documentation. I never give a date because obviously I don't have control over that, but that is the date in the bill. And what is also really important to understand is why there's this urgency. Because originally these Fed Now accounts were slated to come online in 2023. But you see, this really is all about confidence because it's a con game. The fiat system, the monetary system that we live in right now is absolutely a con game. And in 2008, banks lost confidence in each other as witnessed by the interbank lending rate, which plunged, the use of it plunged, because if banks loaned to another bank, they were not sure they were getting that money back. And then it was in 2012 when it came out, it couldn't be hidden anymore, that was an absolutely manipulated stated rate. That wasn't a real rate. It wasn't based on the market. It was just a few banks that get together and say, well, this is what the rate should be, and this is what the rate should be. And it was discovered that traders were actually manipulating that rate so that they made money. Now, you might wonder why that even matters, but you have to understand that every single contract on the planet was tied to that rate. So if you've got traders that are just looking to make some extra money playing with those rates, that means that your mortgage, your car, your credit card, everything is costing you more than it should. So once that was discovered in 2012, then they said, oh, well, we have to get a new rate. And we have to create this whole new market. And there were a number of central banks that started doing that, including ours here in the US. But to create a new market, then have like 6 trillion in contracts convert to this new system proved to be a daunting task at the least. Because in some circumstances, like with derivative bets, which are big financial contracts, and they're just bets, you have to get 100% approval. Now, for you and me, if it's in a mortgage or an auto loan or a credit card or a student loan or any of that, the language is already in those contracts that they can change to any interest rate benchmark that they want to. But it's for the big players, the big Wall Street players, they'd have to get 100% agreement. So they had been really working hard at first creating this new market, but they were having a lot of trouble getting the market to accept and utilize this new benchmark. I personally found it really interesting that during the coronavirus, when the central bank, when the Fed came out with all of these trillions and trillions of dollars in lending programs, and they actually had the opportunity to embed this new, it's called a SOFR, S-O-F-R, to embed this new benchmark into all of those contracts, they didn't do it. They still went back to the LIBOR, which is the benchmark that goes away on December 31st of 2021. So I thought that was really telling, because what they basically were doing in that, in my opinion, was admitting failure. So this whole opportunity, the crisis that was created by this pandemic, and you hear my hesitancy because I can't prove that it was planned, but I've read so much of the documentation. It's awfully convenient. It's awfully convenient.
as you say, that it was awfully convenient, number one. Number two, Powell's speech today really struck me. I listened to parts of it, and it's amazing that in his speech, he's telling people that everything was fine, the economy was strong,
Right.
and there were no inherent problems in the system before the coronavirus. And as you say, this seems like an interesting correlation for the timing of bringing this new system in.
Exactly, and pointing fingers, right? Pointing fingers, and that's a lie. Powell absolutely 100% lied when he said that. And it was just to say, see, it's not what we did. It's this darn pandemic. That's what's making this whole thing go wonky. And really, all of the data tells me and tells everybody, if they look at it, that it's a lie. We already had all the technical indicators. Even the central bank admitted that these indicators were foretelling of a recession. The timing of it was perfect. So yes, you're absolutely right. And that's why we need this new system. And isn't it really interesting to you that they couldn't hit their 2% target, never change behavior, change the way you account for that behavior, change the rule? That's the policy. Keep doing that really bad behavior. And boy, I love this one. If they keep doing this, they might create bubbles. Ya think? The system died in 2008. Absolutely, 100%. The system died in 2008, and they knew it. They absolutely knew it. So that's when they started all those experiments with the QEs and the interest rates and this and that. The economy was so bad. Does anybody remember what happened last September? Almost a year ago, when the money market system froze and the Fed rushed in to pump trillions into the banks again, because the money market system that you're taught to think is like a savings system, right? It's safe. You can put money in there. People forget that it froze in 2008, and they changed the rules that made it harder for you to take your money out of it in the next crisis. And that was about to become apparent to people. And that is a huge funding mechanism for overnight loans to Wall Street players. So, the system was in deep doo-doo last September. And they pumped lots and lots of money into it. They knew that this had to shift. So now, rather than targeting their inflation number at 2%, they're going to allow it. They're going to keep interest rates here. It's going to stay near zero for an extended period of time. They say that they will not go negative, and they say that they will not use yield curve control, which means buying an unlimited of bonds of different durations to keep interest rates at certain levels. Now, they're saying they're not going to do that, but you watch. They're not going to have any choice about it because they are out of tools. And you will ultimately, when they bring in, this is what I think we're going to see the hyperinflation begin, is when they bring in universal basic income. No means testing. Everybody's going to get a certain amount, whether it's $1,200 or I've heard up to $4,000 a month. They're just going to put that in those digital dollars in those accounts. And people are going to go, well, great, because I was struggling so much. So look at all this money for free. There is no such thing as a free lunch. And this isn't going to be free either, because it's going to cost you your freedom. It's like the last nail on that coffin. That's why, frankly, having physical gold and physical silver, real money that you hold in your hand, you hold it and own it, no counterparty risk, that makes owning yourself physical gold and silver critical. Critical. Not just a kind of nice thing to do, not even a thing to do because it's severely undervalued. But if you want to hold on to freedom, You need to hold physical gold and physical silver. And you also need to be able to be as independent and self-sufficient as possible, because we all got a little taste of what's coming in March and April. And that means food, water, energy, security, barterability, wealth preservation, community, and shelter. Because no matter what's happening in the economy, we need this to have a decent standard of living.
To be able to get through this next rough patch, absolutely.
And to thrive through it too,
Mm-hmm.
For the other side of it, because there will be another side. But if enough people do that, then we're going to retain choices. If people just go, well, okay, I don't understand this, so they must know what they're doing. These are the guys that got us into trouble to begin with. Why would you allow them to remain in control?
Because maybe you don't want to think about that, and you think that people that are quote unquote in control are taking care of you.
Yeah, they are. Bend over.
One of your very interesting indicators that I found the other day in doing research for this was the inequality versus interest rates. And
Yes.
as you're speaking about the hyperinflation as well, give us your comparison when in 1971, the value of your $20 bill from June to September, that disparity, both of these are kind of indications of the same thing, correct?
Oh, absolutely. See, when they set up the Fiat system, and Fiat means by decree, so that's government mandated money. And what they knew is, number one, people marry the legal money of the state. So prior to 1913, it was $1. After that, it was $1. In 1971, when they completely took us off the gold standard and handed full control over to private central bankers of inflation, it was still called $1. Now, I don't know how old you are, Tom, but I'm about to be 66, and I remember that period of time well. Even though I was a teenager, I was old enough to see all of the chaos around this shift. And what most people don't realize is that there was a run on the dollar from foreign central banks and foreign governments where they were sending in dollars in exchange for the gold that we held in the system. And it was so intense that by the time Nixon said, nope, you're not going to do that anymore, we had less gold in deep storage than we did after the confiscation in 33. So I can tell you that, I lived through that. My sister Elena was actually at Kent State and was billy clubbed. And, that at that point, the police had gone in and killed several students. I think it was like 4 students that died during those riots and those protests. There was an air of change in the air. But if I had a $20 bill in July and I had a $20 bill in September, and it could have been a brand new $20 bill in September, you didn't know, the individual had no idea that anything had changed. When in reality, everything had changed. And that's actually what just happened today. Everything has changed, even though it doesn't look like it when you're out there, but absolutely 100%, the whole monetary regime just shifted today. Okay, just happened today. And I believe that it's because, without a doubt, they know that we are about to get hyperinflation. And right now, all that new money has been held in the stock market, the bond market, the real estate market, those markets that the central banks targeted back in 2008, Google it, you'll see, for reflation. I wish your listeners would just go ahead and search for reflation trade 2008, etc., and they'll see that. So that's where the hyperinflation is, because you'd have an awful hard time convincing me that stocks fundamental value is up at nosebleed level for the most expensive stock market in history, when who in the world knows what the income is going to be? And we have so many what are called zombie corporations that do not even earn enough money to pay the interest on the debt that they've accumulated And because banks do not want that to show up on their books, they loan them the money to pay the interest on the debts, and then that goes to principal. This will not end well. This will not end well at all. Make no mistake about it.
Absolutely. So as we're speaking about, let's say, as it ends well or ends poorly, one of the things we haven't talked about on the show before was Nasara or Jasara. And again, doing research for this, you're one of the people that really understand that. So could you tell us a little bit more about that?
Well, Nasara or Jasara is, I have crystal balls and they don't really tell me anything. So we hope for the best. It's a system where all debts are forgiven and everybody kind of goes about their lives really happily. Now, I can't say one way or the other whether or not that will happen. But what it really does talk about is a change and a shift and a reset of the financial system. And that absolutely is happening. Historically, the debts that end up getting forgiven are sovereign debts, so government debts, not individual debts. And they want to say that right now there's a debt jubilee going on because of the mortgage. You don't have to pay your mortgage for 12 months, and you don't even have to get an appraisal for 18 months or something like that after you close, and you don't have to pay your student loans for now. So there was a lot of things that are going on making people hopeful that this is ultimately what's going to happen. But history tells a different story. So I think that we should all hope for the best and hope that all those debts get wiped away. But I think we should prepare for the worst because history has a tendency to repeat itself. So you'll hear some hesitancy because it's a hopeful thing, and history doesn't actually really support that. But you can create your own power and change because, and I'll go back to gold for that, because a rising gold price is an indication of a failing currency. And so gold, the true value of gold, its fundamental value for its most important function, which is to maintain your ability to purchase over time and to make sure that you are always fairly paid for your labor. Well, I can tell you for an absolute fact that if they did, and I'm not going to get you to the penny, but I'll get you close. If they reset the currency right now, the way that they formally do it is against gold, because gold is good money. It has full utility across the entire global economy. So it doesn't need a government to say this is money. It's been money for 5,000-6,000 years because of that full utility. I mean, it's used in manufacturing, it's used in the financial system, it's used in medicine, it's used in art, it's used in jewelry. So it has the broadest base of buyer, which is critical because the fiat money, the paper money, or even the digital money, that has utility in one place. So in reality, that has no intrinsic value. And when they reset the currency and the system, which they will have to do after the hyperinflation, and probably do it 3 times on average, can be more than that, can be less than that, but on average, historically, they will reset the value of or the number of zeros in a currency, I should say, 3 times, but they do it against gold. So if you want to see a current example of that, you just look at Venezuela. And during 2012, 13, 14, 15, 16, 17, and 18, Venezuela had the best performing stock market in the world every year. But that's also as they were hyperinflating away the value of their currency. And by 2018, they had so many zeros on that currency, right? A wheelbarrow to buy a loaf of bread. What they did was just lop off a bunch of zeros, reset gold and silver as well, but gold went up something like 3,800%. And it has continued to rise because they didn't change their behavior yet. And the goal for governments, I mean, inflation is great for governments and corporations because it is an invisible tax on your work and on your wealth that they do not have to take through the legislature and make it invisible. So you cooperate. For corporations, you talked about the income inequality. That's what enables income inequality because inflation is based upon goods and services, which the corporations produce. And so in nominal terms, so in number terms, it seems like the average wage earner is making that much more. I mean, back in the early 70s, the average wage was $9,500. And a family of four with one wage earner could live reasonably comfortably on that amount. Now, I'm not saying they were super well off, but they only needed one income for a family of four. Today, the average wage is something like $53,000. And so nominally you'd go, well, yeah, I'd much rather have $53,000 than $9,500, except that it takes two wage earners. You're living from paycheck to paycheck. And what verifies this is the recent $1,200 coronavirus stimulus check that they sent to households that were earning less than $75,000 a year. Back in 1970, somebody's making $75,000 a year. That is a ton of money. You were like a millionaire back then if you were making that kind of money. So for corporations, that's just enabled greater profits. You can go to the FRED, Federal Reserve Economic Department, the FRED, you can just put that in your search bar, and you can see corporate profits. You can see all of this stuff spike since we handed over full control to the central banks. I don't want them to have any more control, and I don't want them to have control into the new system. And I don't mean that they're not going to do this. I mean after all of this garbage is burned off through the hyperinflation.
So, Lynette, as you speak about garbage being burned off and revaluation of currencies, I'd like to get your thoughts on why the Bank of Canada is going to be in real trouble when these kind of events actually start to happen.
Well, number one, today really kind of let you know that it's already in place and already happening. It's just not visible to the masses. And I cannot explain this because to me it's insanity, but the Bank of Canada is not holding any gold. And yet at the same time, since 2008, we have been watching global central banks, not in the US either, by the way, voraciously accumulating more gold than they ever have since they started tracking this. And so Canada's going to be in deep trouble because they have nothing to put into this new currency system. And I just hope the U.S. actually has the amount of gold that they say they have, because it hasn't been audited since the 50s, and it hasn't moved even 1/16 of an ounce. And at the same time, what do we see? We see Russia, we see China, we see India, and many, many, many other countries accumulating, and me too, I'm not a country, but me too, accumulating as much gold as they possibly can. And I'm not even sure that they're really telling us the whole story, but you can look at the data and you can see that for the 10th year in a row, governments, other than Canada, other than the US, have been really voraciously accumulating gold, getting ready for the reset, because those are the countries that will be in a much better fiscal and powerful position on the other side of this reset. And so will the individuals, because 100% of the time, historically, 100% of the time, pretty good percent, you could always convert gold into any other currency or good or service. But you cannot say that about fiat money that loses all value and has officially, again, go to the Fed, put in purchasing power of the consumer dollar. You'll see it for yourself from the horse's mouth, from the Federal Reserve, that it's lost over 97%, almost 98% of its purchasing power value. You can't go by when they say, oh, it's a strong dollar or it's a weaker dollar, because they're gauging that against other fiat currencies. For you and me, it's how much can we buy with this dollar? And I actually just did this. I think Megan's going to post it probably over the weekend. But in 1912, before the Federal Reserve took over, $1 or 1/20th of an ounce of gold backed that dollar. And you could buy 11 loaves of bread. As of 8/24, when I pulled the spot price, even though that's manipulated, but I pulled the spot price, a 20th of an ounce of gold, while a $1 bill would buy 0.33 loaves of the cheapest bread that I could find, 1/20th of an ounce of gold buys 28 loaves. So it's bogus to think, I mean, I know it's that nominal confusion piece, because, wow, if you had a $20 bill 10 years ago, you have a $20 bill today, nominally it's identical. But what it would buy you is vastly different. And with this announcement today by the Fed, that means that they are going to push even harder, damn the bubbles, right? This is the biggest wealth transfer in history. They're going to push even harder to create that inflation, and they need our cooperation to do that. They need consumers to go out and spend. And that's why, I mean, I don't know, we only have 4 months left to the year, but, and I could be dead wrong, because that's certainly not something that's within my control, but I do believe that we will see some form of universal basic income where they're going to give people, now that the Fed Now accounts are all set up and all of that is formalized, and number 8 is formalized, you know, you are going to see, I think, some form of universal basic income where people get money every month. So if you know it's coming every month, you're much more likely to go out and spend it. That $1,200 that they put out, if you had to spend it, you did, but most people saved it because of job insecurity. They didn't know, you know, when their income was going to shift again. So that's when you'll see it. And if you want to watch it in closer to real time, pull up the monetary velocity chart again in the Fed. The Federal Reserve website is definitely, the Fed is one of my very favorite websites, because I think they're more honest in there. And monetary velocity is the speed at which money changes hands. So if you had a great week, for example, and you said, well, okay, I can afford to get that car because I'm confident my income's going to stay the same. So you go out and you buy a car. Well, some of your income is now transferred to whoever sold you that car, right? And let's say the salesperson gets a pretty good check, things are rocking and rolling. Okay, I'm confident that my income is going to stay up there, so I'm going to go take my spouse on this great weekend that we've been talking about forever. And while you're on that great weekend, because you're feeling very flush, you leave a nice big tip, and then the waiter or waitress goes, wow, great, now I can buy Johnny those sneakers he's been needing. So you can see, if you're confident in your income, you are much more likely to spend that money knowing that more is coming in. So once we see that happening, if you watch that monetary velocity chart and you see it go up in a pervasive way, in other words, go up and keep going up, hyperinflation has begun. Right now, when you look at that chart, what you'll see is that the monetary velocity peaked, I believe, in 1997. So that was the last time that taking on more debt was actually stimulative to the overall economy. And it's been declining down ever since. And in fact, the Federal Reserve did a report back in 2016, but their latest data that they used was from 2013. And at that time, the monetary velocity was lower than it was in 1933, when this whole big experiment was really getting kicked off, and it's a lot lower today than it was in 2013. And with all of this new money that they just printed, it's fallen off a cliff. And that's their data, not mine.
Yeah, it's hard to believe that, like you say, in 97 was basically peak velocity, and it's continued to go down since then. And it makes sense that if people are worried about their security, that they would try and save that $1,200 instead of spending it.
And that's actually what they discovered in Japan and in Europe and in Switzerland and in Sweden when they did this great experiment on negative rates that they started in 2009. They thought that people would go out and spend that money, that the banks would go out and loan out that money. But the opposite actually happened. That's why they have to take us digital, because that's the only way to force it. And, in that paper that they did in 2007, how to take us, I don't think I'm doing the title right, but it was essentially how to take us well below the lower zero bound. They used 4% as an example. So we are a consumer-driven economy. They've got to get us to consume. Well, if you sit there and you watch your principal evaporate and you're not buying anything, you're just paying interest on holding it in the bank, what are you most likely to do? Go out and spend it, as you said.
Absolutely. Lynette, something else I'd like to get your thought on is how we're going to finally find that true fundamental value of gold and silver. Is that something that the market is just going to discover as we come out of this and end up finding that value by where that price ends up?
Well, yes and no. It's not the market that's going to determine it, because this is a trading market at this point. Ultimately, yes. But when you're really seeing it go to its fundamental value, it's when they actually, for the first time and then subsequent times, reset the currency. Because they have to take something that has no intrinsic value, so the fiat money, and they revalue it against something that is all intrinsic value, and that's gold money. And the last time I did the calculation, so it's higher now because they've created a lot more debt, because that's how money's created in this system, it was over $12,000. So at $1,950 or $2,000 or $5,000 or $10,000, gold is severely undervalued. And, part of the reason why we've seen gold go up so dramatically, and it bottomed in 2016, it's recently concluded cups, and there's all sorts of technical things that it's done. It's because Wall Street players understand that the end is near. But it is not going to be Wall Street that pushes it, because, wow, I did a study, and it was before I knew how to capture the screens, unfortunately. But according to the Bank of International Settlements, at that time, for every 1 ounce of physical gold, there were 62,000 ounces of paper gold. That's leverage. And that's actually been something that it's been coming to a head. It hasn't exploded yet, but it certainly could, because the players really understand what's happening. So usually when people look at the spot market, they assume that that's the value of gold. No. That's the value of a contract on gold that is highly leveraged, because it costs $150, I am not exaggerating, $150 to control roughly $1 million worth of gold, 500 ounces per contract, and then they expanded the contracts. So, that's pretty cheap. And if you're a central bank, you can control that for $110. That's on the COMEX. You can go ahead and search that and look at it for yourself, and you'll see. But what's been happening, and this is going to be really interesting to watch unfold. Normally, Wall Street traders are just about picking up a few bucks here and a few bucks there. They really don't care. And they just roll those contracts over. But now they've been standing for delivery. In other words, saying, nope, give me my 500 ounces of gold. Well, the exchanges don't have. If everybody stood for delivery, it's so highly leveraged, they don't have it. They don't have the physical gold to deliver out. So I can't tell you when we're going to see fireworks in that regard, but I can tell you that we will. And the reason why they're taking delivery is because they know the system is about to die. And by the way, you see the stock markets making new highs, all-time historic highs, more and more expensive, at the same time that the insiders are getting out in droves. And the insiders are the CEOs, the CFOs, the boards of directors at all of these corporations. And they are getting out while the getting's good, which is exactly what happened in 28. And again, every single time in 2007, and it's happening again. I watch insider activity, and it's the highest that I've ever seen it.
Absolutely. You want to kind of follow the quote unquote smart money, right?
Exactly.
Lynette, I want to be respectful of your time here. There's lots of stuff that we didn't get to, such as bullion versus collectible coins, confiscation, risks of the precious metals ETF. So hopefully we can have you back soon and get to some of that.
Absolutely. This was a great conversation. I really enjoyed it, Tom. And these are all very important things.
Absolutely. Tell us a little bit about ITM and your team there.
Absolutely. I personally have been in these markets since 1964, and I've studied currency since 87. I came to ITM in 2002, and I'm their Chief Market Analyst. But before I got there, based upon my studies of currencies, I created a strategy for myself. Everybody at ITM has been trained in this strategy, so we customize it. Because your circumstances, your age, your goals, and what you have to work with are probably going to be a little different than mine. But basically, if you're working with ITM, you're executing the strategy that I created for myself. And that's really what makes us different than anybody else, because anybody can throw you into gold. But as you said, some of those topics that we didn't get to talk about, there are nuances in these markets. And it's just the right tool for the job. So we put your goals absolutely first. What are you trying to accomplish? And we create a strategy around that so that not only can you survive with your standard of living reasonably intact through this whole reset and transition, but on the other side of it, come out in a much, much more powerful financial position than when you walked into it. And that's what we focus on. We have long-term relationships. We are a family, and that's what we like to do to help people. We're here to be of service.
Excellent, Lynette. And that's itmtrading.com and the same on Twitter, correct?
Correct. And also in YouTube, I post a lot of material constantly to help you understand what's actually happening, regardless of what anybody blah, blah, blah says. And I also like to give you the links so that you don't have to take my word for anything. In fact, I don't want you to. I don't want you to take anybody's word for it. But I try and make it easy for the individual to do their own due diligence and see what I use to create my opinion and what I think is going to happen and what it means.
Absolutely. You guys do a great job on your YouTube channel. And like you say, there is a ton of valuable content there. Lynette, thanks very much for your time today.
This was great, Tom. Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?